With food inflation expected to rise in double digits, recession on the horizon and possibly a 50 basis point rate hike predicted by the end of January, the rand at record lows and showing no signs of abating. You really want to manage your own money in 2016? Well, if you're going to insist on doing that, you're going to need some guidance. Joining me on this episode of the MoneyMakers is Andrew Bradley. Andrew Bradley last year wrote a fantastic book called How Much Is Enough? Andrew Bradley joins us on the line from Cape Town this evening. Andrew, it's nice to have you with us. 2016 looks like a year of complete horror, potential devastation, and a time to be hiding under the desk rather than sitting at it.
I think your summation is pretty good, Bruce, sadly so. I think never before, certainly in my working sort of time of the last 25, 30 years, have I seen a divergence of views in outlook for the year. So we've got a couple of people who ironically are somewhat positive, but most people are incredibly negative. I just think there's so many different variables that come into play this year that predicting what's going to happen is fairly impossible. But having said that, most of the news and most of the probable occurrences look significantly more negative than positive, sadly so.
Okay, so we're in a negative environment. How do we cope? As ordinary people who may have a financial advisor, maybe we think we're geniuses because markets since 2008 have gone up in pretty much a straight line. We've either picked ourselves some shares, or we've either picked ourselves a portfolio of unit trusts or ETFs, and it's been going swimmingly until last year where things began to get just a little bit ropey. What do we do?
Well, I think the first thing in any financial planning process is to make sure that you look internally first, and that you have your house in order, your affairs in order, and understand exactly where you are. Because I think many of us just brush over that aspect, sadly so, because it's a bit inconvenient and it's not glamorous stuff. But unless you get those basics right and make sure you're very clear about what you're going to be doing, whether you're going to be retiring, whether you're going to be buying a new house, going to a new business, whatever it might be, make sure you get that right. Because the worst thing, particularly in times of uncertainty like this, is when you change your mind. Changing your mind costs you money, potentially big time. So first look internally, make sure you know what you are needing to achieve and that you have your plans clearly set out. Once you do that, then the next thing is, well, where am I going to? And then making sure that your portfolio, from an investment point of view and in every other way, is clearly geared towards that. So it's mostly the dull, boring stuff, which we'd prefer to ignore. But unless you have that foundation in place, talking to a financial planner, talking to any investment professional is actually a second or third order conversation. Start there.
I mean, you often make the point, and you've done it in your books, and you talk about the issues around the psychology of losing money versus the psychology of earning money, earning returns. We're far more averse to losing money than we are happy about making returns. We anticipate returns. The moment we don't get a return, or the returns are very low, we start getting very jittery, and it's at that point, I suspect, where bad decisions are made.
Yes, sadly so. When we don't have the right frame of reference, we don't know what we are looking to achieve, and we're not sure why we've structured our investment portfolio in the way we have, when things go slightly awry, which is pretty much the space we're in right now, then we tend to panic and sadly do the wrong things at the wrong time. So, losing money, no one ever wants to do that. That's not why we work, and that's not why we invest. But when you've invested in growth assets, shares and property kind of investments, then times like this do occur. It's not just all great returns over the long term. You have to be able to sort of bunker down in times like this. So make sure you understand those basics of what you're doing and why you're doing it, and that might help you make sense of what's going on in your portfolio and what it needs to achieve.
Easier said than done, though, Andrew. I mean, when it comes to a year like last year, and you religiously put your $500 a month, or your $1,000, or your $5,000 into an ETF or into a unit trust, and you look at the end of the year, and you could almost have done as well putting cash in the bank on a 12-month fixed deposit. It becomes harder to sell the investment proposition of markets, doesn't it?
It certainly does, and I think that comes back to the point of what you are trying to achieve and how you're going about it. There are times when putting your money in the bank will be a better proposition, but in most instances, over a long period of time, investing in markets will give you a much better return. I think statistically over the last 100+ years, 3 out of 4 years will give you a better return in the markets than they will in cash. But again, we never know when that 1 year is going to be, and most people lose more money trying to anticipate that and moving in and out. And therefore, it's never a good thing to have, the old proverbial saying, all your eggs in one basket. So you should have a component of money in cash and, in bonds and in property and in equities, and also not just in South Africa, but have a globally diversified portfolio. So those things sort of balance each other out and reduce your risk quite considerably. So if you've got a very concentrated bet, then right now I can't imagine you getting too much sleep. But if you've diversified your portfolio and you understand that you need to see things out, because if you've got a 1 year view, your approach must be and should be different. But if you've got a 5, 10, 20, 30 year view, which even at our age, we've got a 30+ year view.
At your age, I mean, can you really afford a 30-year view, Andrew? Can you really?
I think I have to, Bruce. I'm 53 now. I certainly have every intention of being around in 30 years' time when I'll be 83. And the reality is, if I put all my money in cash right now, I'm going to struggle to make sure that I survive and can afford to feed my family in 30 years' time. So my money is going to need to last me 50 years plus. So having that perspective and having the right balance to my portfolio that's sustainable. It's
a terrifying prospect, Andrew. I mean, what you say is absolutely spot on, because more and more people are living longer and longer. Also in Johannesburg with me is Adam Helper. He is a broker with Discovery Invest, and he joins me in studio. Sorry to have ignored you all this time, Adam, but I mean, you listen to Andrew Bradley, and it's about balancing portfolios and doing the right things all the time. But it's at times like this where investment markets start off 2016, and in the first week, 5% is knocked off the value of the JSE. Gold, which nobody would touch last year, Harmony's up 50%. The gold price is at record levels in rand terms. You've got clients with eyes about as big as yours are right now.
Yeah, thank you, Bruce. I want to, just following on what was said, the diversification will always be the bottom line. It's going to save you when the equities are bad. You're going to have the cash saving you, and obviously when booming times, which I don't know if we're necessarily going to see this year, those, then obviously equities is where you want to be. So the principle of diversification sticks, and I think that is most important.
What are your clients telling you right now? Because a lot of clients, and a lot of your clients, I'm sure, would have been absolutely flabbergasted, as markets were, as ordinary South Africans were, by the sacking of Nhlanhla in December last year. Suddenly, a lot of the trust in the South African financial system has been eroded. What are you telling them?
Entirely. And for people to invest, or for people to start any form of a long-term plan, they need to feel confident. They need to be confident in the country, and it's unfortunate that such all those events that went on in that 1 week was it was blood on the streets. It was horror, and I had nothing to say. It was just a point where, how do I build confidence myself? So obviously in that 1 week we thought it was doom and gloom, and there is a bit of a ripple effect at the moment, but if we just withdraw from that 1 week and we look at...
You're the ultimate optimist. You're the ultimate optimist,
Adam. Have to be positive in order to to expect a return.
I want to go back to what Andrew was saying a little bit earlier. And Andrew, you're saying at this point, when things are tough, don't change your mind. But there is a very famous saying that when the facts change, you do need to change your mind. Have the facts in South Africa changed enough for you to change your attitude to a sustainable future for South Africa?
Yeah, I think just to clarify my comment about not changing your mind, I think possibly a better way of putting that is being disorganized costs you money. And that's what I'm saying, chopping and changing your mind in that respect from your perspective. But absolutely, if the environment is changing, you have to look at that. But you've got to be very clear, is the environment changing? I think there was one comment in that week which really perplexed me, and that was our president's speech after the axing of Minister Nene, where he said, we're going to a fundamental change. This is a watershed point in how we look at the economy and how things should be valued, how commodities should be valued. Now, if that was to actually occur, then fundamentally, from a South African point of view, how our economy was going to be run would be very different, and one would need to look at it very differently, like it was 25 years ago when Mr. Stolz came along and said we're going to have real positive interest rates. All of a sudden, how you looked at bonds and fixed interest investment was totally different and needed to be. So right now, I don't think there's something there that we can say absolutely the landscape has changed. In my opinion, after that hiatus, there's still a lot of water to flow under the bridge for us to see exactly where we are. But it's not something that, from that perspective right now, I would be panicking and saying it's back to the drawing board. There's a totally new environment. I think we had a bit of a hiccup, a bit of a test and a challenge, which we would have better to avoid, unquestionably so. But I'm not, I certainly was wailing and gnashing my teeth for a week. But right now I think it's time to be very, very sober, very responsible, and very cautious and considerate. There's no doubt, certainly again statistically, this is the worst start to our market in more than 30 years, and the worst start to the US in more than 20 years. So these are not trivial things that are going on at the moment, and that's why we need to be incredibly responsible, not only as people who are the custodians and advisors to clients, but for clients themselves.
We will leave it there, but thank you. Every euphemism in the book, Andrew Bradley in Cape Town. He has written the book, of course, How Much Is Enough? Adam Halper, just wrap up with you. It's the worst start to a year in 20 years in the United States. It's the worst in 30 years in South Africa. How are you going to power forth? Because you're by nature, I think, an optimistic kind of bloke.
Yes, I generally stick to the positive approach. I think it's the way to go. Most of my clients are sort of my age group, mid-30s. We generally a bit more ambitious than, and we can afford to be a little bit more ambitious than the older clients. And I think as long as we stick with the fact that, where is it better in the rest of the world? China's in a complete, I read they're sort of moving backwards. You look at Brazil, you look at all the rest, Europe is at war. You've got a situation where we've got to make best with where we stand. And I think, when the chips are down, which as you say they are this year more than any other in the last 30 years, I do still believe that there is room for the GDP to improve.
He's ever the optimist, is Adam Halper. He is a broker at Discovery Invest, and in Cape Town, Andrew Bradley, who is, of course, the author of How Much Is Enough. There'll be more Moneymakers tomorrow. Till then, bye-bye for now.